All right, guys, welcome back to the channel. And in today's video, I want to address a couple questions that came in last night in the comment section of my most recent video, which is titled Ray Dalio, Composer and Hedge Fundies Excellent Adventure. I'm just going to scroll down here, and this subscriber, FA9082, said, I do question why you are using 76 different symphonies. You could have had a 42% CAGR over the last 10 years using a strategy of buying and holding QLD and just moving to cash when QLD is below 95% of its 200-day moving average. Max drawdown in line with triple Q despite double the return. This is compared to the SPY CAGR over the same period of 15%. And triple Q CAGR of 21%. It's a great question. I'm going to answer that in a second. And then we have Glory Days, who's been following the channel for a while. He wanted to know about the 10-day max drawdown. He says, one question about the adjusted hedge fundy strategy. What is a 10-day max drawdown exactly? Is it a rolling 10-day window? And the drawdown is measured with respect to the first data point within the 10-day window? Or is the drawdown measured with respect to the latest peak, no matter whether it's within the 10-day window or not? I assume the former, because in the latter case, you would almost never stay invested. So I believe, Glory Days, that it is the former, though you could email Composer or I can reach out to them and find it out. But that would be my thought as well, that it's based on the days, not the peak to draw down. But let's actually take some time here on the first question. Because I've had this from other people as well. The 76 different symphonies that I'm running in Composer with approximately $2,000 within each symphony. So let's look at Portfolio Visualizer just to kind of do a little deep dive into his numbers here. So we're going to scroll over here, and I have this pulled up. And so you see Pro Shares, Ultra Triple Q, Ultra Pro. So this is QYLD, the first one, 38%. T Triple Q, 53%. Triple Q, 21%. And then the Vanguard, 14.66. So you can see $10,000 on T Triple Q turned into $1,063,000. QYLD was 350-ish. Triple Q was 80, SPY 44,000. There's a big difference between, look at the difference between the T Triple Q and SPY over this last 10 years. So it's just fascinating information there to look at. But one of the things I wanted to do with Composer, and in a way it's descended from Ray Dalio, is to build out a system that's running 50, 100, 125, what have you. Right now I'm at 76, as he mentioned. Different strategies that are lightly correlated, slightly correlated, lowly correlated, negatively correlated to each other, and have them running concurrently. And to see over a period of 5, 10, 15 years, what the Sharpe ratio, Sortino ratio, Kalmar ratio, what they are over the long term. So if anything, this 150,000 is a mathematical experiment that I wanted to run, that Composer is allowing me to run. And as I said in my last video, just because I'm doing this doesn't necessarily mean that you should do something, with 76 symphonies. You may be better off with just a few symphonies. But the thing is that I have other investments. For those of you who follow this channel, I have my TD Ameritrade. I have things that, just in very vanilla index funds. I have a lot of value stocks that I'm doing research on. So I'm using option strategies. So I have a lot of different buckets. So even if this 150 went to zero, which is highly, highly unlikely, but let's say it went from 150 to 50 at a time, or 75, 50% drawdown, I really wouldn't feel it. Now, if this is your only 150,000, and this is your retirement fund, you may very well feel that. So it goes to suitability in investing. What's good for one person may not be good for another. And so, but I'm just fascinated because I think that, as I mentioned, I used a line the other day that there were 50 trades in 2 seconds. That's what Composer has given me the ability to execute, which I could not do on my own. It's impossible for me to do that on my own. So yeah, I just think, and we'll see in time how it plays out, that the Sharpe, Sortino, and Kalmar ratios, the risk-adjusted returns, can be pretty wonderful on these strategies. It's interesting though, to your point about running 76. Even someone said, well, because you're running 76 strategies and there's the bid and ask spread, that you're gonna chip away at alpha on some of the strategies, which overall, by running that many, by chipping away on some of the alpha, that it may not be worthwhile to do it. So we'll see. Again, I'm not saying that I'm right. I'm not saying that someone that's saying that is wrong. I just am fascinated to see over the long term how running this many symphonies plays out in time. What the CAGR is, what the Sharpe, Sortino, max drawdowns, all those kind of metrics will be. And I wanted to play to that point is, and I recommend, if you get nothing else out of this video, I would recommend, this is Ray Dalio's breaks down his Holy Grail. I would recommend watching the full 4 minutes and 43 seconds. I'm just going to play about 2 minutes of it, just so you can get a sense of the idea of, when Composer was being built, I was saying to the founders, I said, to me, the power of this software is when it goes multi-symphony. For me, just to be able to run a symphony or two is exciting, but it's not earth-shattering. And to me, the ability to run 50, 100, 150 strategies, whatever your number is, to me is game-changing. And it kind of, in a way, goes back to this video here. And again, I would watch the whole thing when you get a chance, but I'm just going to play 2 minutes here for you.
Look at that, how that changes according to the levels of the correlation. I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good uncorrelated return streams. Things that are probably going to make money, but you don't know, but they have a good probability of making money.
So there you go. That's a great line there. 15 or 20 uncorrelated return streams. So I'm running 76 in Composer, so it's a lot more than the 15 to 20. But again, I just, I got creative when I had the software. So I said, what if I did this one? And then if I did this one, I just started kind of going wild with the software and creating more and more. And it'll be fascinating to see the correlations between the symphonies throughout. But the whole genesis, in a way, comes back to Ray Dalio here.
Money, and but you have that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you could do is find the investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. Like if I can get zero correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay, as distinct from 40% with any one of us. So
that's why I do think, again, with my 76, I'm running eventually, it'll probably be 100. And if I can get the correlations low or slightly correlated, now he's talking about zero correlation, the chance of losing money in every given year will be much reduced. So that's an interesting point that he makes there. Now, I wanted to also play a contrasting clip, because what I also discovered the more you study investing is that Ray Dalio is talking about the power and importance of diversification for investors. And Ray Dalio has been immensely successful. His hedge fund, I believe, is the biggest hedge fund in the world. His net worth is in the multi-billions. But it's very much in contrast to Warren Buffett and Charlie Munger at Berkshire, where concentration is key. Those who employ value investing and sort of the Berkshire method is that diversification, I would say, is for know-nothings, but diversification is for when you really don't know what you're doing and you don't want to get hurt so much. Whereas Dalio is saying, no. It's not for know-nothings. Diversification is for people who really understand markets, essentially, who really understand risk. That it's for elite investors. Diversification is not for just the average Joe who's kind of doesn't know what he's doing, and so on and so forth. And there's multiple clips. This one is titled "Diversification is for Dumb People." I don't think Warren Buffett says that, but we'll play. This is a 59-second clip, and there's other clips with Warren and Charlie. You can just type in Warren Buffett. Actually typed in Buffett diversification, Charlie Munger diversification. And this will just give you a sense on the contrasting investing philosophies of Bridgewater and Ray Dalio and Warren and Charlie at Berkshire.
Diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. And it's conventional practice, and if all you have to achieve is average, it may preserve your job, but it's a confession, in our view, that you don't really understand the businesses that you own.
So notice how in that clip, Warren Buffett uses the term business instead of market, stock market. He just really views the stock market as a place to buy wonderful businesses. So he doesn't look at it as a ticker symbol. He's really doing deep analysis in the business, whereas Dalio's view, he considers himself a global macro investor, is much more macro. I don't know if there's that deep analysis of individual businesses that you get with like a Peter Lynch or a Buffett. So it's just, again, just something that's fun to look at in a way. Both have been tremendously successful, but it's really antithetical pathways. So one last thing I'll show here, just in Composer. We're going to go over here. And in the future, it would be really cool on the right. So you see net deposits, current value, trading sins, trading frequency. On the right, to showcase total return of the symphony. And another feature that would be fascinating to this point of this video is to be able to track the correlations between symphonies. I don't know if that's possible to track and to see, but to click on, this one versus this one, and then to see correlation over long periods of time, 3 years, 5 years, 10 years. That to me would be quite interesting to see. So that's pretty much it for today, guys. Just wanted to thank those particular followers for the questions. And just hopefully that explains why I'm running the 76. Again, it really comes down to kind of a 5, 10, 15-year mathematical experiment on this 150,000. And that you guys can follow along with it and see that it was a success, a moderate success, a failure, a total failure. So there it is. Take care. Ciao.